Welcome to TalkTickers, where we cut through the noise and get straight to the signal.
That's what we do.
Today, we are diving deep into the first quarter 2025 results for Crescent Capital BDC. You probably know them as CCAP.
Yep, CCAP. And our mission here is really to unpack what management presented on their call.
Exactly. We want to understand the results, sure, but also the story behind the numbers.
And what they're seeing out in the market right now. So we'll look at the figures, dig into the details, the context, the whole picture.
All right, let's jump right in then. Give us the snapshot. What were the headline numbers for Q1?
Okay, so for the first quarter, which ended March 31st, 2025, net investment income, or NII, came in at $16.6 million.
$16.6 million. And per share.
That works out to $1.45 per share. And just quickly, NII, that's basically, the core earnings from their loans and investments minus expenses and interest costs.
Got it. $0.45 per share. Now, how did that compare to the previous quarter, Q4?
Well, that's the key point. It was lower. Q4 2024 NII was $20.5 million,
Okay.
which was 55 cents per share.
Right. So a 10-cent drop per share quarter over quarter. That definitely stands out.
It does.
So what did management say? What were the main reasons for that decline? Why did the NII move down like that?
Yeah, they broke it down pretty clearly. They pointed to four main drivers for that change.
Okay.
The biggest piece, they estimated it hit NII by about 4 cents per share compared to Q4.
Oh.
That was lower base rates.
Okay. So the effect of interest rates moving late last year finally flowing through.
Exactly. There's often a lag. Floating rate loans and their own borrowings, they don't always reset at the exact same time.
Right.
So the impact from rate changes late last year hit the income side, maybe a bit more than the financing cost side this quarter. Net effect about 4 cents down.
Makes sense. What was driver number two?
Second was the runoff of some non-recurring income items, things that boosted Q4 but didn't repeat.
Like one-offs.
Yeah. Specifically, they mentioned one-time PIK income from two portfolio companies. That accounted for roughly 3 cents of that higher Q4 NII.
PIK income. So payment in kind. Interest added to the loan balance, not paid in cash.
That's the one. Nice when you get it, but yeah, you can't really bank on it quarter after quarter.
Okay, so 4 cents from base rates, 3 cents from PIK runoff. What's third?
Third factor was lower dividend income from their Logan joint venture. That was another decrease, about 3 cents per share quarter over quarter.
From the Logan JV, any reason why that dividend dropped?
Yeah, they said management decided to preemptively end the reinvestment period for the underlying CLO structure in that JV sooner than they technically had to.
Interesting strategic move there. Okay, that's 3. What was the last piece?
The fourth factor, which they pegged at about a 2 cent per share decrease in NII, was an uptick in loans placed on non-accrual status.
Non-accruals, where they stop counting income because the borrower isn't paying.
Exactly. The numbers they gave, non-accruals went up to 3.5% of their debt investments measured at cost.
Okay.
And 1.8% measured at fair value.
So were these big systemic problems popping up or something else?
Management characterized them as resulting from one-off credit events at specific companies. They added 4 names to non-accrual.
4 names.
Yeah, but they were all first-lien positions, which is good, means they're senior. And together, they only represented less than 1.2% of the total portfolio at fair value.
Okay, so relatively small impact in terms of value.
Right. And they also mentioned these specific names were already on their internal watch list. So not a complete surprise, perhaps. They don't see it as like broad systemic stress.
Got it. Isolated issues already being watched. So given these 4 drivers, what's management saying about this Zazar M45 NII level? Is this the new normal?
Well, they kind of framed this quarter's $1.45 as a more, let's say, reflective baseline going forward.
A baseline.
Yeah, but they did also point out some potential near-term tailwinds, things like getting the full benefit from financing adjustments they made after the quarter ended.
Right. You mentioned that SPV repricing.
Exactly. And also just the full quarter impact of running at their target leverage. But importantly, this baseline view doesn't assume anything about, say, future non-accruals or where base rates might go next.
Okay, that baseline comment is helpful. Let's pivot then to the portfolio itself, the loans they actually hold. What does it look like? How healthy is it?
It's a pretty substantial portfolio, just over $1.6 billion at fair value right now.
Wow, okay.
And it's spread across 191 different companies. Management really emphasized that diversification helps with stability.
Yeah, 191 companies. So the average position size must be pretty small.
It is around 0.5%, 0.5% of the total portfolio on average. So if one company gets into trouble, it doesn't sink the ship,
Right. What about concentration at the top? Any really big bets?
The top 10 largest borrowers make up about 18% of the portfolio. So there's some concentration, but it sounds like they're actively managing position sizes to control that credit risk.
And critically, where do they sit in the capital structure?
Mostly senior. 91% of the portfolio at fair value is in first-lien loans.
91% first lien. That's high.
It is. That's generally the safest place to be as lender. They also talked about industry diversification spread across 20 broad sectors with a focus on non-cyclical businesses.
Trying to avoid the big economic swings.
Seems like it. And what about who owns these companies?
Good question. Sponsor backing.
Yep. 99% of their debt portfolio is in companies backed by private equity sponsors.
Okay.
And they gave a weighted average loan to value across the portfolio of 39%.
39% LTV. That sounds pretty conservative. Explain that for us.
Yeah, LTV compares the loan amount to the company's value. So the 39% LTV means there's a really significant equity cushion below their debt. The company's value would have to fall quite a bit before their first lien loan is underwater. It definitely points to a defensive posture.
Okay, 39% LTV, 91% first lien. Feels pretty solid. How do their own internal risk ratings reflect that? Is the portfolio performing well by their metric?
Their weighted average internal risk rating was 2.1 on their scale that suggests overall stability.
2.1, okay.
And maybe more importantly, 87% of the portfolio by fair value is sitting in their top 2 risk categories. Meaning those investments are performing either at or actually above their original underwriting expectations.
87%. Okay, so despite those few non-accruals they added, the vast majority seems to be doing just fine.
That's the picture they painted, yes. Signals overall health.
Let's talk about activity. New investments, market conditions. What did they deploy in Q1 and what are they seeing out there?
Okay, deployment. Gross deployment in Q1 was $105 million.
$105 million out the door.
Right, and nearly all of that, 98%, went into first lien loans, sticking to their strategy. About $78 million was in totally new companies, and $27 million was add-ons to companies they already lend to.
And net deployment after repayments and stuff?
Net deployment was positive, about $27 million for the quarter.
Okay. Were the terms good on those new deals? Spreads?
They said the weighted average spread on those new investments was around 565 basis points.
5.65%.
Yep, 5.65%. They seem pretty happy with that level, called it attractive.
Okay. What about the broader market vibe? Any particular challenges or shifts they highlighted?
They did mention something interesting. They said Q1 started off strong, activity was good. But then came the White House tariff announcements and that 90-day pause on implementation. That apparently caused some deal sponsors to hit pause, especially on new platform deals, kind of a wait-and-see moment.
The macro environment creeping in.
It added to the deal backlog, they said.
So how worried are they about tariffs impacting their existing portfolio? Did they address that?
They did, yeah. So they reviewed the portfolio specifically for tariff exposure.
Oh.
Their conclusion was that because they focus a lot on service businesses, which don't use a lot of materials and tend to generate good free cash flow, their overall direct material exposure is pretty modest, around 4%.
Only 4%.
Yeah. Plus, they focus on core and lower middle market companies, often serving domestic U.S. markets, which limits the cross-border trade exposure. They feel things like the ability to pass on price increases and not being overly reliant on single suppliers puts the portfolio in a decent spot to handle it.
Makes sense. Did they talk about competition or where capital is flowing in private credit?
Yes, definitely. They touched on market segmentation, noted the huge inflows going into non-traded BDCs, like $3 billion a month, they said.
Wow.
But that money is mostly chasing deals in the upper middle market. Think companies with over $200 million in EBITDA. And that's putting pressure on spreads in that part of the market.
So CCAP sees an advantage in staying focused elsewhere.
Exactly. They're focused on the core and lower middle market where they see less direct competition from those massive non-traded BDC flows.
Interesting dynamic. Did they see spreads move much in Q1 overall?
They mentioned that public market credit spreads widened a bit, maybe 25 basis points after the tariff news.
Okay.
But the private side tends to lag, and they hadn't really seen any significant widening in private credit spreads yet.
Got it. Okay, let's shift gears to the other side of the balance sheet, their funding. How are they financed? Any changes there?
Yeah, they were pretty active on the capital market side. Remember back in December, they priced $150 million of new senior unsecured notes.
Right, the bonds.
They drew that cash down in Q1, and those notes have maturities way out in 2028 and 2030, which is good.
pushing maturities out.
Definitely. And then just after the quarter ended, in early April, they did something with their SPV asset facility.
What was it that?
They right-sized it, reduced the total capacity from $500 million down to $400 million.
Cut it back. Why?
Well, they said $400 million gives them enough capacity, but reducing it lowered the borrowing cost on that facility by 50 basis points.
Ah, okay. Save some money on the spread.
Exactly. Dropped it from 245 over the benchmark rate down to 195. So manages interest expense while keeping enough liquidity.
Smart move. So how does the overall debt maturity profile look now after these changes?
Much better, actually. They said 76% of their total committed debt now matures in 2028 or later.
76%. Wow, that's a big improvement. What was it before?
Just 2 quarters ago was only 42%. So big shift.
Huge shift. And the cost of all that debt?
The weighted average stated interest rate on all their borrowings was 6.36% at the end of March. But if you factor in that SPV amendment they did in April, on a pro forma basis, it drops to 6.17%.
Okay, 6.17% pro forma. And leverage, where does their debt to equity stand?
It ticked up slightly during the quarter from 1.19 times up to 1.25 times.
Mostly due to that net deployment.
Primarily, yeah. But crucially, 1.25x is right in the middle of their stated target leverage range.
Which is?
1.1x to 1.3x. So they're exactly where they want to be, operationally speaking.
Good context. Okay, let's talk dividends. What did they declare for Q2 and what's the philosophy there?
For the second quarter, the regular dividend is $2.42 per share.
42 cents. Consistent.
Very. And they also confirmed the second of those 3 special cash dividends they announced earlier.
The 5 centers.
Yep. The 5-cent specials related to undistributed taxable income, or UTI. The next one is payable in June. Management really emphasized their track record here, earning the regular dividend consistently since inception.
And did they earn it this quarter, the $1.42?
Yes. NII was $1.45. Dividend is 42 cents. So they covered the base dividend this quarter. They reiterated their strategies about consistency and protecting NAV stability.
Net asset value.
Right. Protecting that NAV stability rather than chasing higher base dividends, especially when rates were volatile.
Makes sense. What about that variable supplemental dividend framework they have? Any supplemental this time?
That framework is still technically in place, yes. But no supplemental was declared for Q2.
Why not?
Based on their formula, there's a test involving excess earnings, and this quarter the test cap basically exceeded 50% of the available excess earnings. So the threshold for paying out a supplemental wasn't met.
Okay, so the mechanism exists, but conditions weren't right this quarter.
Pretty much.
All right, we've hit the main results. The drivers, portfolio, market, funding, dividends. The Q&A sessions on these calls often add some really good color. What interesting bits came out of the Q&A this time?
Yeah, a few things definitely stood out. First, more on those non-accruals.
Okay.
Management gave a bit more detail, reinforcing that these were really company-specific issues, stuff they'd been watching. Not, broad sector problems, although one was a software name tied to a tougher end market.
And how they handle those situations.
They talked about their workout approach. Priority number 1 is preserving capital. They prefer to be constructive, work with the sponsor if the sponsor is stepping up.
Yeah.
But they also made it clear they're willing to be proactive. That could mean selling the loan or even potentially taking ownership of the company if that's the best way to maximize recovery.
Taking ownership, that's a serious commitment.
It is. They stress they take a longer-term view, willing to put in the time, the work, maybe even more capital, not just looking for a quick fire sale in the secondary market.
Interesting insight into their process. What else from the Q&A?
There was more discussion on that, Logan JV, and why the dividends can be kind of lumpy.
Right. The 3-cent impact this quarter?
Yeah. Management explained the structure has mezzanine and equity parts, and the timing of cash flows from the equity piece doesn't always line up neatly with quarter ends, leading to volatility.
So the drop wasn't necessarily bad credit in the JV.
Apparently not. They linked this quarter's lower distribution specifically to technical things like over-collateralization tests within the CLO structure, retaining cash. Not a big shift in the underlying loan quality.
Okay.
They did hint at some potential near-term upside from BSL reinvestment activity after quarter end, but still cautioned to expect some lumpiness from that JV going forward until the CLO winds down.
Got it. Anything else major? Buybacks, maybe?
Yep, buybacks came up. Someone asked. Management gave the standard answer, really.
Which is?
The board continues to look at it, evaluate it. They have to balance the potential short-term appeal of buying shares below NAV.
Especially if the stock price dips.
Right. balance that against the longer-term need to maintain a stable equity base, especially given their portfolio size and wanting to stay within that target leverage range. So no commitment, but it's on the radar.
Okay, standard playbook answer there. That Q&A definitely adds useful texture.
It really does.
So summing it up, we've covered the why behind that NII drop, base rates, runoffs, the JV, non-accruals. We looked at the portfolio, pretty defensive, high first lien, low LTV, mostly performing well.
Right. And the market context, the tariff impact, that segmentation between upper and core lower middle markets.
Plus how they're managing their balance sheet, pushing out debt maturities, optimizing costs, staying in their leverage target, and the dividend strategy consistency over chasing yield covering the base.
And those Q&A nuggets on workouts and the JV mechanics.
We've really taken a deep dive into the Crescent Capital BDC Q1 2025 earnings call. A lot to digest there. What stands out most to you listening back to all this?
Here's maybe a final thought for you to chew on. We heard management talk a lot about that market segmentation, right? How those big non-traded BDCs are flooding the upper middle market.
Yeah, pushing down spreads there.
Right. So think about CCAP's specific strategy, focusing on the core and lower middle market, sticking heavily to first lien sponsor-backed deals, keeping that LTV low, prioritizing NAV stability above all else. How does that specific approach potentially position them differently compared to maybe other BDCs chasing different types of deals or taking more risk in this current, pretty complex private credit landscape? It makes you wonder, where are the best risk-adjusted returns hiding right now? And how are different players like CCAP positioning themselves, not just for opportunity, but also to handle whatever challenges might be coming down the pike? Something to think about.